Joining us here at Post 9 to make sense of all of that is Alger CEO, CIO Dan Chung. Dan, thanks for coming in. Good to see you. One thing Colin said was it's natural for people to want to celebrate good news, and by that she means some of the recent data that points to disinflation. Does that mean this rally is any less legitimate?
Not at all. Actually, when I was here in early October, last time I was on the show, I thought we were at the beginning of a new bull market. I think the strength of the rally after the Fed pausing and the inflation numbers that we just got, the reaction, I think, shows you sort of future direction of equity markets.
And you do think that going big in terms of cap, mega cap, is the place to start?
Well, I would certainly not give up on most mega cap positions because these are high quality companies with great free cash flow, and many are at reasonable valuations, like Meta is a very reasonably valued company. On the other hand, I think the markets will broaden and it'll be more of a stock pickers market in the future, and so we'll have to look outside the Magnificent Seven.
Sarah?
Dan, you don't think that the market's getting too excited about rate cuts, moving them into first half of 2024 when the Fed is telling you we're not thinking about cuts yet. Don't take more policy firming off the table. Core CPI is still elevated. The Fed has been more right than the market lately in terms of the signals.
Well, that's an excellent point, but I think it's a lot of the attention on the Fed and the whether they cut or whether they hike near term is going to create some volatility. But in the bigger picture, we're clearly towards the end of the rate hiking cycle, if not already done. And then next year, the Fed has said they'll stay higher for longer. But my point there would be the absolute level of rates where we are now has actually been a refresh, a restart for equity markets. We're at levels that are still well below, for example, where we were in the 90s.
What about if the economy worsens further? We're starting to see the impact of all that tightening. That's the other variable here, both for the Fed and for the equity market. At some point, if the soft landing story doesn't maintain itself.
Again, an excellent point. We think actually one of the trends to watch next year will be the consumer, but we think the consumer will end up being stronger than expected. And so a soft landing is our view. And we'll also note that the markets are driven also by earnings, right? In fact, I shouldn't say also, more by earnings, we think, than, say, economic macro. Earnings are reaccelerating. And if you look at the quality of U.S. companies and the positioning in certain industries like technology around AI, the consumer and e-commerce, very well positioned to show good earnings growth next year, even in a slower economy that we think is still not going to be a hard recession.
Speaking of tech and semis in particular, we got some 52-week highs in names like KLA and Micron, and we've seen some tactical upgrades of names like Intel and the chip space at large. Of course, we got NVIDIA next week. And how much is riding on at least their guidance being solid?
I mean, short term, a lot is going to ride on NVIDIA. But longer term, we like NVIDIA, and we like the AI trend. And I think, it's going to broaden out into other companies that either enable or benefit from AI, companies like AMD, actually Vertiv, a company that's in the specialized cooling for data centers.
Yeah.